Welcome to today's special episode on the value of patience, a core concept in Benjamin Graham's investment philosophy. In this video, we'll explore the profound importance of patience in investing, something that Graham believed was absolutely essential for long-term financial success. This video is not just for new investors, but for anyone looking to understand why patience, not speed or speculation, is the true key to wealth. We'll dive into Graham's teachings, real-life examples, and practical advice on how to cultivate the right mindset. So, sit back, relax, and let's journey into the world of value investing and the power of patience, the core principle of patience. Benjamin Graham's philosophy was built on the understanding that investing is not about instant gratification or chasing after quick profits. Instead, he viewed investing as a long-term commitment to building wealth. Let's start by defining what Graham meant by patience and why it was a core pillar of his strategy. What is patience in investing? Patience is the ability to wait for the right opportunities to come your way without rushing into investments based on speculation or market trends. It's about allowing your investments to grow over time, trusting in the fundamentals, and waiting for the market to realize the value of the companies you've chosen. Graham's view on speculation. Graham often made a distinction between investing and speculating. Speculation is driven by the desire for quick profits, while investing is based on a long-term approach. He warned against making emotional decisions or being swayed by short-term market movements. The role of patience in value investing. Value investing, as described by Graham, is a patient, disciplined approach. Unlike growth investing, which focuses on finding the next big thing, value investing requires a calm and methodical approach. Let's take a deeper look into how patience plays a key role in value investing. Understanding intrinsic value. Patience allows investors to calculate the intrinsic value of a stock without rushing the process. The goal is not to buy into the market frenzy, but to purchase stocks that are undervalued and have room to grow over time. This long-term perspective is what sets successful value investors apart. Patience through market volatility. Stock prices are volatile, and they can swing wildly in the short term. A patient investor doesn't panic when the market dips. Instead, they understand that these fluctuations are part of the cycle. They see market downturns as opportunities to buy good stocks at a discount. Mr. Market, a lesson in patience. Benjamin Graham's famous Mr. Market analogy provides a valuable lesson in patience. Mr. Market is a fictional character who comes to you every day offering to buy or sell his shares at a different price. Some days, he's euphoric and offers to sell at inflated prices, and other days, he's despondent, offering his shares at rock-bottom prices. Understanding the Mr. Market analogy. This analogy teaches us that the stock market is not always rational. Mr. Market is influenced by emotions, creating extreme swings. However, as investors, we don't need to follow his mood swings. We can patiently wait for a time when the stock is undervalued and buy it at a fair price. The emotional roller coaster of market cycles. Graham emphasized that patience helps investors stay grounded during both the euphoric and depressive phases of the market. Let's look at some historical examples where patience paid off, such as during the Great Depression or the 2008 financial crisis. Real-life examples of patience in action. Now that we've covered the theoretical aspects of patience in investing, let's explore some real-world examples. Patience is often the difference between losing money and making a fortune. Let's dive into some iconic case studies. The story of Warren Buffett. Warren Buffett, a disciple of Benjamin Graham, is often considered the epitome of patient investing. Buffett's strategy involves buying undervalued stocks and holding them for the long term. We'll break down some of his most successful investments, such as Coca-Cola and American Express, and see how patience played a key role in their success. The long-term success of index funds. Index funds have proven to be one of the best ways for individual investors to achieve long-term wealth. By being patient and staying invested, index funds have outperformed many actively managed funds over the decades. The value of holding through market crash. Let's look at investors who have weathered market crash, from the dot-com bubble burst to the 2008 financial crisis, and how their patience led to success in the long run. The dangers of impatience, how it derails your investment strategy. While patience is essential, impatience can be detrimental. In this chapter, we'll explore how rushing into investments or trying to time the market can lead to disastrous results. Chasing hot stocks and market trends. Many investors, in their eagerness to make quick profits, chase after stocks that are in the spotlight. This behavior often leads to buying at inflated prices and suffering significant losses when the hype dies down. Timing the market. The fallacy of predicting the future. Graham cautioned against trying to predict market movements. Timing the market is a fool's errand. Investors who try to predict the ups and downs of the market often end up buying high and selling low, which is the exact opposite of the strategy you should adopt. The psychological impact of impatience. Impatience often stems from emotional decision-making. Fear of missing out. FOMO and greed can cloud judgment, leading to rash decisions that don't align with a value investing philosophy. How to cultivate patience as an investor. So, how can you develop patience as an investor? The good news is that patience is a skill that can be cultivated over time. Here are some practical tips to help you develop this key characteristic. Mindset shifts. Start by adopting a long-term mindset. Shift your focus from short-term gains to long-term wealth building. Understand that investing is about the slow, steady accumulation of value over time. Setting clear goals. Having clear financial goals and understanding your investment strategy will help you resist the temptation to react impulsively to market movements. Discipline and consistency. Investing regularly, whether it's through dollar-cost averaging or sticking to a diversified portfolio, is a great way to cultivate patience. The more consistent you are with your investment habits, the easier it will be to stay the course. How to stay patient during volatile markets. Market volatility can test even the most patient investors. But staying calm during periods of high volatility is one of the best ways to build wealth over time. Understanding market cycles. Market cycles are inevitable. By studying market cycles and historical trends, you'll be better prepared to handle market downturns without panicking. How to use volatility to your advantage. Volatility can create buying opportunities. Instead of selling during downturns, consider using these times to buy undervalued stocks at a discount. In conclusion, the value of patience cannot be overstated in investing. Whether you're following Benjamin Graham's teachings or simply trying to make better financial decisions, patience is key. By adopting a long-term mindset, being disciplined, and learning from history, you can avoid the pitfalls of impatience and build wealth that will last for generations. Remember, investing is a marathon, not a sprint. Stay calm, stay disciplined, and allow your investments to grow. Thank you for watching this extensive guide on the value of patience. If you found this video helpful, be sure to like, share, and subscribe for more in-depth financial wisdom. Until next time, happy investing. Thank you for watching. Stay tuned for upcoming videos on Benjamin Graham's investing philosophy and how you can apply it to your own portfolio.